welcome to the University of Essex for our series Space to Grow. Welcome to the new year. I hope you had an eventful Christmas and New Year. And let's see how 2021 brings our good fortune. The Space to Grow program is here to help and advise entrepreneurs, and in this case, especially investors, on how to invest more wisely. Are you asking the right questions? That's something that we should be thinking about. As you can see, we're not shy in coming forward, and we'd like you to be exactly the same. This is your opportunity to ask questions. Some very experienced people in the room. So, talking of which, I would now like to say that Rod Beer is with us. Thank you very much, Rod, from the UK Business Angels Association. I'll let Rod do his own introduction because he's not shy in coming forward. But certainly, thank you very much indeed, Rod. And I'm now going to hand over the screen to you. So would you now like to screen share?
Thank you, John and Josh. Thanks, everyone. And hi, thanks again for having me. So this session is all about investors. Are you asking the right questions? Conducting due diligence on a deal is not, and doing a session on it isn't always the most exciting, pumping session. So I'm going to try and keep it as engaging as possible. On that note, feel free to post questions in. I think there's a Q&A section at the bottom, or post it in the chat. I'll monitor. In fact, I'll try and monitor them as well. I've got a second screen over here where I can see them coming in. So feel free to post your queries in there, or put your hand up, or ask whatever. Absolutely fine. And we'll keep it as an engaging, kind of interactive session. I've actually split it into two parts because I think it's one thing to try and explain to you all what are some of the questions you should be asking of a founder as part of a due diligence process. But I think before you get to that stage, I think it's important to have a better feel or understanding for what are the sort of aspects that make an attractive investment proposition in the first place, because it's that kind of core, that core position generally, which what drives your DD to make sure that it's ticking all those boxes of it being an attractive investment to get involved in. So I've broken it up a little bit into two sections, which should hopefully make sense. So we're going to crack on. So a bit introduction to us. So I'm Managing Director, Roderick Beer, of the UK Business Angel Association. We're a not-for-profit trade association, privately funded though. We represent about 200 companies from across the UK. All told, they are collectively investing, I think, a little over £2 billion every year into UK-based businesses. As a trade association, our role is complex, multifaceted. We do a lot of work around building better connectivity, so we want great investors to work with and meet other like-minded investors, and for them to invest their money into great founders. So helping, great founders, accelerators match up with the great angel groups and VC funds that we have as members is really important to us. We also do quite a bit around that representation piece. This is early stage investing, a really important part of the UK economy. In fact, all the exciting unicorns and scale ups and exits in the future often start at angel funding, and the government recognizes that and supports a lot. So we work by kind of gathering and conducting research to understand the needs and the views of the community and championing those needs at government level and at international level as well, in fact. We also do a bit of work around promoting angel investing as an asset class, because there are many places and weird and wonderful ways that you can deploy your spare capital. And it's my view that angel investing is actually a really attractive option, with the tax breaks that are there, with the potential returns investors achieve, but also with the fun and the involvement that you have along the way. So you do quite a bit of work around there. And then finally, as a trade body, a big piece of our work is around education. We want investors to deploy their capital as successfully as possible, because it drives returns, which is great, but that fundamentally also drives successful companies. These businesses are succeeding and doing well in their own right, and are helping to grow UK PLC, which is quite key for us all as well. So that's us in a nutshell. So we're going to go in now to, I guess, the first part of this two-part session, where we're going to kind of look at, how do you actually pick the right business? What does a good, I guess, investment look for? And I'm going to go about half an hour for this. So do bear in mind there are many things that make up a good business, but it's really about giving you a bit of an overall understanding. And I think also, quite a big audience here. So, that you'll have different interests, investment interests, your own investment thesis that might focus on certain sectors, stages, locations. So this is trying to give you more of a general feel as to some of the things that we think and that we often see make a really good potential investment opportunity and what investors generally want to see in a business as well. So let's just kick off with the three big key standouts. Big piece number one, and in fact, I think I've got some stats coming out later on, but actually the most important factor of a successful business when you're investing in it is the management team. You know, a really good team could sell a terrible product because they have a really strong method for getting that product into the market. They have charisma, they've got good relationships, good contacts. A great team is incredibly important. In fact, I think something like 70 to 80% of an investor's decision to make an investment is based upon because of the quality of the management team and their perceived ability to execute on their own business plan. Really, that's really important. And I really cannot iterate enough how important it is that it's a good, credible CEO, co-founder, founder, supporting team around them as well, who in a number of ways, not only are they very credible in their own right, but they also understand where they're not so good. They understand it, they know it, and they can fill those gaps of any holes in the management team that they may have as well. So I think that's really important. And things that you want to see in a team is, have they invested themselves? Has their friends and family put some money in? Are they truly committed to this business? Have they got any other part-time interests? Again, it's kind of touching into the DD bits. We'll get in a little bit later. But fundamentally, do they inspire confidence? It's a big chemistry thing at this stage. And really, it's about if you're impressed by the management team on a personal level, your gut instincts are really good, ticking the box from a due diligence perspective. Anyway, the next thing that's important to look for in a business is something that's kind of truly scalable, can actually be scaled. There's a big requirement, a big market need for it. It's something that can really grow. And the reason that's important is from an angel investment perspective, when you're looking at deals, any one business that you invest in needs to have the potential to give at least a 10 times return to justify the investment in the first place. You might invest in 10 companies. All 10 companies need to have the ability to hit a 10x return, because in doing so, if one of them pulls it off, it makes your returns, or even two, it makes your returns and then someone covers off the losses and those that don't succeed. So you need something, you're really looking for a company that can actually scale. This is why software, digital technology is really, really popular with investors, because of its instant and immediate scalability, which I think is really important to bear that in mind. Services businesses don't tend to do well. Retail can be quite challenging as well. So how scalable is that? Is the product or service that this founder's developed? And the other thing, and the really important thing, is that market fit, that kind of keep the USP, but also their market fit. It's important because there needs to be a market for this product or service, and there needs to be a problem out there in the world that is painful enough, big enough, and costly enough to drive people to want to buy the product or service to alleviate that problem, generally speaking. And that's really, really key. And having examples or instances of some kind of customer traction, corporate traction, pilots, letters of intent, that kind of thing is, I think, quite important. So justifying that market fit, there is a market out there and they actually could well want this product, is a really big key thing to look for. So those are the kind of, I guess, the three biggest standouts when looking for a business. And then we can go into a few other bits, which I think are also really important too. Now, this is I mentioned about this and the kind of importance of, it's a bit of a load of data, a load of graphs I don't always like covering off, but actually it's from our research. We do a big bit of research with the British Business Bank, where we try to understand the do's, the don'ts, the ins and outs of angel investing across the UK. And it was, so we spoke to investors who'd had a number of exits, and we said, what was the reason that the business did well? And the number one reason on the left-hand side, if you can see my mouse, which I'm guessing you can, is the quality of the entrepreneurial team. The second reason the investor think it gave them a return was because they chose well. So they made a good decision on them. Really interesting thing is that in red, it's those who are over the age of 55. Below the age of 55 is the blue. And you'll find the younger you are, the more likely you are to think that it was your own choosing was the reason it was a good outcome. Whereas the older, I think it's probably the hubris of youth, perhaps. Whereas the older thought actually it's a better team and I'm just lucky. Because actually the older you are, they think a large part of it is actually it's just a bit of luck, and there is always that in investing. But really good teams, really important. the quality of the business is really important as well. And also, it's a key thing. I wanted to kind of, this is from the investors' mouths, from hundreds of investors' mouths, which is really important. And then we looked at why in your portfolio did companies fail? And the number one reason is because of a poor management team. So that's kind of really does highlight the fact that you're really looking for a great, credible team. Also, they also ran out of money, needed more than they expected, so they ran out of money. A lack of sales or profit, so they ran out of money. Economic environment, they ran out of money. Other, probably ran out of money. Poor market fit, didn't get the sales, ran out of money. It comes down to not enough funding to be able to either pivot or to also not get the sales as quickly as they had. So reasons they fail, they run out of cash and or poor management, and cash will come in because they can successfully secure and raise because they get product market fit traction. There's enough scale out there to actually get some good customer traction as well. So just kind of, I want you to kind of bear that in mind, that this a lot of it's guidance, advice, and points for me is statistically driven, and it comes from the horses' mouths collectively. So it's all about team, right? It's really important, and it's about what you want from a founder. Is more than just it's someone who actually has some industry knowledge. For instance, do they understand the industry they're working with? Or if they're quite young and just quite switched on, do they have an advisory board? Or do they have a good, strong network of people within that industry? Because if they don't, it's going to be really hard for them to get some good traction with customers if they don't really know one in the industry, or to understand the product market fit. You know, what's really making customers want to buy their stuff? It's because they understand the needs of them. You know, some good, strong business experience you want to see from them. You know, again, really young is fine and it's great, but they need to have some sensible business experience behind them, either on the board of directors or advisory board, or supporting them, or in an important role. Financial and or emotional commitment to the business is important, because, you know, if the going will get tough, and you don't want to make it too easy for that founder to just walk away, unless if they put their own money in, or if their relatives have put money in, then they are emotionally and or financially committed into the business as well. So because it will get hard at times, and you need to make sure they're going to stay there. Also, although you want to see a bit of I guess entrepreneurial charisma and a bit of a blagging from a founder, because it's quite strong. Beg for forgiveness, don't ask for permission, that kind of thing. Investors, when it comes to the crunch, still want to see founders that are a bit more humble, because the founders are not going to have all the answers from the outset. They're going to make loads of mistakes as they go through. Things that they assume are going to be wrong, and they need to be able to be humble enough to learn and listen to those who've had the experience. One example, our Angel of the Year a couple of years ago, Megan Horton Berry, who's a really, really experienced leading angel investor in the UK and the States, in fact, as well. She does a few things with the management team. When she speaks to them, she'll ask them a really hard cutting question, which she knows for a fact they do not or will not know the answer to. And she's more interested in the way they respond than what their answer is. If they try and blag it a little bit, she's not going to be very comfortable with that. She wants someone to say, oh, actually, I don't know the answer to that, but I'm going to go out and find it for you. Or they know the answer and they give an honest response. So yeah, you're absolutely right. It's a big potential problem. We don't know that yet. I'm hoping that some of these actions we're going to be taking over the next 6 months will help us to learn that risk factor, so whether that key thing is going to happen. They care about the core personality kind of attributes and traits of a founder, of a founding team, and not as much so on their maybe academic background or their business background is important, but they want to see some good personality there as well. And then that kind of ties into the final point: is they're going to be impressive. You're going to be like, you know what, that individual really impressed me. I think they've got the vigor, the strength, the tenacity to go ahead and make a really good chance of this. And that's why one of the best due diligence tools you have out there is your gut instinct, because it is quite a personal thing. Investing and getting to know the team and being impressed by them is a big step in the right direction. So your gut instinct is generally right. I think almost all the times that I personally have gone against my gut instinct, I've been wrong. So generally, follow your gut instinct is kind of, I guess, one of the things that a bit of a key point to make for you all. Now, I wanted to kind of get across this kind of product to market fit. I mentioned that as one of my key standouts, and I think it's what we often see, depending in the different sectors, is that, you know, it's a product or a service that's either brand new and there's nothing like it out there. That can be a big problem, because if there's nothing like it out there, customers don't know that they need it necessarily as much. And so that means a lot of education and a lot of marketing, a lot of work needs to go in to drum up the customer interest and to understand that they need this product to make their life better, quicker, faster. So that can be a problem. So you need to bear that in mind. Then there's also the thing, and I see it a lot, is that I've got no competitors in the product. We're so much better than anyone else. The biggest competitor to most businesses is inertia. You know, I purchase and get my things in a certain place, and I'm generally happy with it. I've not got any problems. Yes, I can see that yours is a bit better and cheaper, whatever. But to be honest, I'm actually very happy where I am. So yeah, I'm not going to buy it. And that's what that means, is that the product or service the founder has to be have a really meaningful improvement or uptick to justify a change in buying patterns, and to change a big corporate to undergo a massive tender and purchase process to take on a new technology. They have to have something that significantly changes the game. You know, not just like incremental tiny improvements probably won't be enough, especially when there are almost certainly other competitors out there. More often than not, you see a founder, they stand up and they make that crazy claim, there's no one else out there who can do what we do. And because we're investors, we speak to all the other founders who are in stealth mode, and so we know actually you're one of 4 that I've seen this week. So not quite true. So you've got to be careful around that and thoughtful. And that's why it matters to have a really strong product market fit. So a great product that makes a really big difference is important in our view, because that's what drives it all. Just having a quick check on any comments or Q&A. Cool. So another thing is, it's one thing for me as a founder to say, I've got the best thing since sliced bread and I'm going to sell loads of them. But it's another thing to back up with proof points. And I think angel investors, the friends and family, will invest at proof of concept stage. So when they've come up with the idea, they're developing it out a little bit, you know, they might have their MVP, their minimum viable product, their first little thing they can maybe show people, which might not actually be commercial. But that's where friends and family tend to get involved and invest. But angels tend to want to see some commercial traction. And that doesn't mean sales, a dedicated, you know, set up sales team that are churning these out the door. It means something that it's an independent validation from a customer or potential customer or industry leader or figure, independently saying, you know what, I like it, it's good, what they've said is true. Yes, that is a really big improvement over what's there, and that is actually really compelling. That's what you're looking for as a bare minimum when making an angel investment. You don't want things that are just an idea and haven't been proven. You want things that have had, and I've got a little list here, you know, some early sales, some pilot sales, some free pilots with a big corporate or another customer, some trials, some letters of intent, just things that are showing that people who aren't their mum have offered to or would like to buy the product. So it's like external industry experience validation point. And that can also come from other investors already involved. Someone might be really experienced within the industry and said, I'm going to put some money into that, in which case, that's great. They obviously know quite a bit on the inside and can see it. So you want to look for something that can demonstrate the very bare, at least the bare beginnings of some commercial traction as well. Another thing, and the earlier on that you invest, the less likely this is going to be the case, and it's fine. But I think as investors, you saw the number one reason a business failed was a poor team. The number two was really them running out of cash and not having enough money to either get to sales or profitability, or to pivot to get their products good enough to start getting the sales and productivity. It comes down to cash and investment. And what is common very early on as well are founders who have a somewhat naive view on how much funding they can actually raise justifiably. The number of decks I see from early stage founders who are raising 150, 200K this round, and their next round will be a Series A. Angel round, straight into Series A institutional, 2.5, 3 million pounds, 5 million pounds. I see it all the time, but it's generally very hard for that to actually happen. Most VCs differs on different sectors, of course, but generally an institutional investor, if they're going to write or be a part of a decent part of a £2 to £5 million round, want to see decent revenues. And the kind of generally the kind of the overall rule of thumb for a lot of VCs, especially in like commercially facing things in digital technology and B2B SaaS, all that kind of world, they want to see £1 million in revenue run rate. So they're turning over about 80 grand a month roughly. And they want to see a really high growth rate. They want to see 10, 15, 20% month on month growth. So it's hitting really well and it's really going. That's when they typically get involved, when you start to hit those metrics. And so for a founder to say, in 12 to 18 months time, I'm going to do my Series A. Well, in 12 to 18 months time, on the back of £250,000 investment now, are you actually going to get yourself to £1 million revenue run rate, and also give yourself an additional 6 months to conduct negotiations and find the right VC and get your head to terms and some money? And the chance generally no. So what I'm getting at is you want to see founders who at least understand or have a reasonable idea of what their funding journey will look like, so they don't run out of money. And I'm very happy to, maybe if someone wants to cover a little bit about what sort of funding rounds make sense, how much they should be looking for, how long it should last. I'll give you a rule of thumb. There should be, any funding round should last a business 18 months, 12 months of growing the company and achieving great things, and 6 months of raising your next round. And in that 12 months, they need to have gained enough traction to justify another funding round. And that next funding round is normally 30 to 50%, maybe even bigger than that, than the last one. So 250, maybe a 400, maybe a $500,000, maybe a 750, the next one. Then they're starting to get towards that Series A piece as well, is the typical stepping stones of investment rounds to get to institutional investing. So it's important to see that and have an understanding for that. Often with younger founders, they may not have that in place, and that's where investors bring to the table a bit more experience around what's actually out there and can amend the plans to reflect reality. So bear that in mind. Another thing is to look for, it's important, is, I'm not a charity, I'm not giving it away, I'm wanting some return. Yes, I want to make a difference in the world, I want to maybe invest into impactful businesses, I want to give back to my local economy and to my industry by investing in the next generation of technology and entrepreneurs. But actually I also would like to make an exit so that I can put that money into my kids, or ideally, actually, more often than not, reinvest it into yet more founders and make a even bigger difference. And so the big point here is to avoid or watch out for a lifestyle business, which is really common, where the founder's going to get it to a certain size and just sit back on a nice salary and do nothing. They are called zombies because they're not going bust because they're actually trading and they're okay, but they're never going to exit because they ain't growing. So they're just called zombies because they just bob along very happily. But they're the worst thing for an angel, because if a company goes into liquidation, you can claim loss relief on your EIS. If a company scales and exits, you make a load of money. But in between, if they're a zombie and they're doing okay and the founder's having a great time, they are the biggest lost, actually, oddly enough. So liquidation's better than average performance. So bear that in mind. And I think I see a lot of lifestyle companies that I just think, is that a global business? Is that big scalable? Is that a really big opportunity? Are they hungry enough for it? There's a lot of them out there who have these great ideas and want to do things, but actually, in reality, can they get 10x growth? Are they hungry? Have they got the passion, the experience, the connections to make that happen? More often than not, the answer is no. So just bear that in mind. Don't need to see a 5-year exit plan because it's all nonsense in the future. But understanding the will to drive a big business and what exit will look like. Who's going to buy you? Oh, exit in 3 to 5 years by trade sale, IPO, or management share buyback is absolute nonsense. It's 7, 8, 9, 10 years minimum. No, IPOs they're picking up a little bit, but they're pretty much dead and buried. In fact, it's going to be a trade sale. So who's going to buy you? Why are they going to buy you? And at what rates are typically buying things? Is it an acquisitive market? Is that going to happen? Is there consolidation happening? I think just having a feel for there being an exit for you at some point potentially in the future and it being feasible is something to look out for, and that's important. And yeah, it's a bit of stats around this is the actual stats around where the exits came from. So just to kind of reiterate how I'll exit by IPO, all that kind of stuff that you see, these boilerplate exit comments are just pointless. The most common way of exit was through going into liquidation, which is generally not a good thing, but that's the life of the investor. The next one is trade sell, and just to put it out there, other is a more common exit methodology than IPO. So puts that into perspective. Interesting to see a growth in secondary sales to VCs and PE, which is good. But most of the time it's trade sell as an exit. So how's that going to work? Any questions from anyone at the end of that little segment? Then we're going to go on to, we're halfway through the chat, halfway through the time. We're going to go now into a bit more technical, the questions and that you could be asking as part of a more detailed, in-depth due diligence process. Does anyone have anything they want to ask or query or state? Speak now.
Okay, I'd ask a short question. I mean, in your experience, have you ever come across any founder only, in other words, no team present, that have actually received angel funding at that early stage?
Yeah, they do, but it tends to be more of that family or friends or through maybe a co-founder coming in and putting money in. It's very hard when they have nothing around them for an angel to say, well, here's some money. They should have some level of commitment from other people, and that shows the skill of the CEO to bring other founders, technical founders, commercial founders in alongside them. Some investors will not invest in the business unless there are 2 or more founders already, which is interesting. Others are less worried about it because the argument is one founder is a lot of pressure for one individual, but actually 2 or 3 of them can spread it a lot more. We've got some questions coming in here. Thanks a lot. Why you should exit from your own business? It is a successful. Good question from, so why should you exit from your own business? As a founder from your own business, why should you exit? You don't have to. Often you may not have a choice because you might have started the company, and as it's grown and scaled, it's kind of outstretched your own capabilities. And often that next round of funding, the final round of funding will say, look, it's time. The business is plateauing, you're not right, we've got the right CEO, it's time for you to step aside and take it forward. It's very common for CEOs. It's very rare for a CEO to found a business and take it all the way through to significant success and survive, Series A, B, C, D funding rounds. It's rare. It does happen, but it is quite rare. So sometimes you don't have a choice. You don't need to exit either as a founder. You can just stay there and have a good time. Mr. Bezos hasn't yet exited Amazon. I'm sure he flogs a few. In fact, he has a structured way of selling shares as part of it. And same with all the big guys. They haven't exited because they don't need to. But many investors along the way, most of the angels, if not all of them, probably would have exited by now because of the great price point. And why not? My 50 grand's worth a cool few million quid, or actually probably significantly more than that. So I'm going to exit. So it's about an exit for the investors and not for the founders, is the point on that. After how much time investors should expect returns? Big question. Generally, the rule of thumb, this is not a short-term game. So although EIS says you have to hold the shares for a minimum of 3 years to get the qualification, that doesn't mean your exits get you come in after 3 years. In reality, many exits take place from a minimum of 7 years. So it's a long time before this is a long-term game. This is not a short, sharp, get some returns. And in fact, all the portfolio return data we have around the angel piece, which actually shows really good returns, are based over quite a long period of time. You can't just, this ain't no flash in the pan thing. This is a long-term game. So your first return may not be for a minimum of 7 years, some 3 to 5 years. I've known lots of, you hear all the stories of I put money in and I made a massive return in only 3 years. It happens, right? But, the reality is expectations, bare minimum of 7, 8 years, sometimes longer. Our UKBAA awards, we had our exit of the year. Last year's exit of the year was the investor invested when they were worth 1.5 million. 2 years later, so they were almost run out of their EIS. It exited for £650 million. It's like a massive exit, amazing. I think 2.5, maybe 3 years, going from 1.5 million valuation to 650 million exit. Boom, amazing. The year before that was a company called Buybox who won the exit of the year. That was 30 years. It was our leading angels' first ever investment, and it took them 30 years almost to get an exit. But actually, it still worked out as a really good exit because it was really good, and actually, it's a really good story. So it's a bit of a mix, I've got to say. Anthony's sort of a portfolio, say $500,000 spread across how many investments? So that's a very different question. So good question, very good question. So we have quite a lot of data and stats, not in this presentation, because we did another one, John, the A to Z of angel investing, where I cover more of that around the numbers behind investing. But to give you a rule of thumb, a bare minimum of 10 investments. If you've got £500,000, let me tell you the mechanics of that, because that's not 50 grand as 10 companies, and that's the bare minimum. You want 15 is the golden number, is a minimum 15 to 20 businesses as a portfolio to increase your chances of a portfolio return. That's what it comes down to, because 60% of the businesses, 80% of the companies you invest in will fail, will not give you any return. It's that 1 in 10, 2 in 10 that makes such a massive stonking return that covers it all off. And because it's that 1 in 10, 2 in 10, the more you do, the higher, significantly higher the chance of getting that 1 in 10. If it's 1 in 10, you invest in 5 companies, there ain't no half businesses out there, so it doesn't quite work out. So that's why it's kind of 15 to 20. And if you got £500,000, what I would be probably doing is I'd be writing £20,000 checks. First check, 20 grand. There you go, or even less if you want to. And then I'd probably making sure that you can follow on that funding, because they'll come back for more money as a founder. So you probably write your first check, 20K. Second check, you can have another 20K, maybe 15, 10, whatever you think you can do, but support them for their next funding rounds moving forward. So I'd probably be doing it that way around. The more the merrier from a portfolio perspective, spreading it across the portfolio, and also being prepared to reinvest in other companies that are actually performing and matching and tracking well alongside the plan. How do you value IP, especially in a specialist high-tech business? Good question, David Wallace. The short answer, you don't. There is no value to, I see lots of, here's an independent valuation review of our intellectual property. And it's done by some accountant in wherever. And it says, well, if this business was to achieve X, then it could be a valuation of this IP. But the IP's, if it's got a terrible management team who've raised no money, then that IP is worth diddly squat. So at early stages, IP we don't value anything on IP. It's more about the collective gut instinct view of the quality of team. Yes, the IP, but really it's commercial traction and how likely it is to succeed. That's how you kind of gut instinct value a business. So it's not really specifically, you can't really value IP. What is a sensible success rate by value? E.g., £50 invested, how much return over 9 years? Good question, straight answer. I've got a straight answer for that, Anthony. It could be 0, it could be a lot. The average across the portfolio. So we've done a few things, we've done a lot of research, we track all the portfolio returns, etc. We also even did a Monte Carlo simulation where we entered all the exit data from last year. We ran a Monte Carlo simulation basis on making £10,000 investments into millions of businesses and what is actually tracked returns. And the answer is not 42. The answer is it is a portfolio. The average return on investment is between 15 and 25% per annum. So over 9 years, it's significantly higher than that, but actually it works out per year between 15 and 25% return, not including tax breaks, which is why it can be really attractive. But that's on the basis of having over a 10-year period, 15, 20, 25 businesses in a portfolio. So the golden number was 15 to 20 businesses in a portfolio as a minimum, and over a 10-year period, an average return of 15 to 25% per annum, which is really strong. So that's what's really good. But caveat emptor, they'll be in that range. This is an average, so there'll be those up here and probably a few up here and plenty down here. So you need to be, bear that in mind. I hope that kind of answers it. Do you entirely trust audited accounts? If they even have audited accounts, most companies are not required to have audited accounts. We don't have audited accounts at UKBAA, I don't think. No, you don't need to use it under the threshold of turnover or whatever it is. I'm not familiar with what that is, but I trust audited accounts unless they have a fraudulent accountant, in which case, unless you're an experienced forensic accountant, you'll be lucky to spot that. So I think you probably should, if they even have audited accounts. I think it's most startups will be really early on in their revenue. So more about one thing to look out for is make sure that any grants received aren't being posted as income or revenue. They're actually, you can see that they're grants and they're not blagging it, because you can do that from GAAP accounting. But yeah, generally I trust audited accounts over unaudited any day, but you won't get audited accounts for quite some time. What is the best method of evaluation of an early stage tech business? Don, this is the best valuation of an early stage tech business. Let your finger stick it in the wind and see which way it's blowing. It's really, it's a thing that people argue and talk an awful lot about. And from my experience, there is a bit of a way to work it. There's only one remotely scientific way to work it out, and I don't even think that works. The way the VCs do it is through DCF, discounted cash flow. So they work out cash flow, they discount it back, etc., etc. The big falling down, and you'll see some of the people. I did a talk at Cass Business School. The professor of education, of entrepreneurialism, was trying to explain to angel investors to do it by DCF, and it's just, I said, look, that doesn't work because there aren't any cash flows. It's a pre-revenue business, or it's a very early pilot revenue business. And so in which case you'll be basing your cash flows on a cash flow forecast. And who put together the cash flow forecast? It's the CEO of the management team. So it's just literally pie in the sky and generally over the top. So DCF does not work at early stages. One thing you can do is, in theory, and it's really complicated, not even perfect, is you look at what's a good return if I want to make a 10 times return, that means, you can work out in 10 years time, if they exit for X amount of money, so that means they're going to be, say, 5 times revenue or 2 times EBITDA, or whatever the exit multiple might well be for that industry. Work yourself backwards to present day and factor in multiple funding rounds diluting you down by 10 or 15% every time. And that's then you can work your way back to find a good valuation, which gives you enough of an equity stake to get you a 10x return then. But it's all so, who knows, it's all so much in the future and pie in the sky. The way to do it, really, the way I do it is, it's roughly a founder should be giving away between 15 and 25% of their business at each funding round. At each funding round, they will raise as much as they can justifiably get away with, given their team, their traction, and the quality of their business and their product. So if they're super early, they're only going to be able to get their hands on 100, maybe 150K if they're lucky. So 15, 25% of 100, is in exchange for 100 and 150K is going to give you a valuation, and so on and so forth. As they get more grown up, they can probably a bit of a team there, some early traction there. Maybe they can raise $500,000, and then their valuation is based on they're giving away between 15 to 20% on that. So that's really the kind of guesstimate. How much could they justifiably raise, which also gives them 18 months of runway, gets them some good commercial traction, and they're giving away between 15 to 25% in exchange for that investment amount. That is typically at early stages how they do it. As you get into institutional land, there's more DCS and other things. How you work out the commercial traction in a basic way. I'm going to get onto the DD bit in a minute. Actually, really halfway through, lots of questions, which is great to see. In a basic way, it's about what can they prove to you around customers, speaking to people. Okay, I'm going to get onto that soon, so I'll come back to that one. David Wallace, would you be suspicious of an entirely crowdfunding business? Yes, David, I would. And the reason is it hasn't yet had any grown-up money, which is really harsh. I like crowdfunding. Crowdfunding has an important part. Others in my industry are less convinced. I like it. I think it has a really important part within our ecosystem. I think it's done an awful lot of good for our ecosystem as well. And yes, 15% of investors on crowdfunding platforms are experienced angels, in fact, which is a good thing. 40% of the angels that we know invest on angel crowdfunding platforms. That's a really good thing to know. So there are some serious investors out there, but the bulk of it, the sheer bulk of the money going in through crowdfunding platforms are from inexperienced investors. And so also crowdfunding platforms are famous. They actually are a service platform for the founder. They have no services or fees given to the investor. All of their services and all of their fees are delivered to and levied on the founding company. And so it's the founding company that they have to support. And so what they've been famed for, less so nowadays, but certainly before, are very high valuations, which people get all excited with a snazzy video and a fun beer and some free beer and a hat, and you invest in a really high valuation. And it's really common for there to be a post-crowdfunding down round. There's a post-friends and family down round, because as a founder, I convinced my mum to invest in me. And she obviously thinks I'm the best thing since sliced bread, but the real world doesn't quite see it that way. So it's quite common not that common, but it's risky, higher chances of there being a down round from a friends and family round because you overvalued your own price and no one had the experience to do that. And the same from the crowdfunding. And that can be, getting a down round can be a bit of a death knell for a business. So if they've only had crowdfunding, it shows good commercial traction. They might have picked up some good angels, but I'd be a bit cautious on their valuation and that they're not overinflated a second valuation, because they come into the real world and speak to real big investors writing decent checks of 25 grand and not a tenner, and they suddenly have to really, look them in the eye and convince them of a high valuation. So that's my big point around crowdfunding, but they have certainly got their point to play, their part to play rather. So we're into part 2, 20 minutes left. I'm lucky I've put we've got less time for the last part, because the last part is a bit more boring. It's the actual due diligence questions, which is the whole point of this session, John, so my apologies, but it's just a bit like, conduct due diligence. So there are effectively 5 key areas of due diligence that you can do. In the bottom right hand corner, you'll see a little purple thing, available for download, the UKBAA due diligence checklist. I'm going to send that in PDF form to Josh and John so they can send it out for you guys to use and abuse as you see fit. It's a legal checklist that you can, in theory, send to a founder and ask them to go forth and complete and send you all the bits and bobs. It covers all the little things to look at from a legal perspective, like insurances, certifications, IP ownership, all that kind of stuff. So really handy. And I think I've also got a general guide on DD. So if I've got that, I'll ping it over. It covers the sort of the areas that I'm covering here too. So I'll make sure they've got a nice little handout from a goodie bag, all free because we're lovely. So the first thing it's broken down into 5 key areas. I'm going to dive into each area in turn. The people, management team are very important. The financials, so the forecasts, the financials, where they're going to be in 2 or 3 years' time, their current accounts that they've actually got, if they've got any reasonable, worthwhile accounts and not just some random export from zero. The commercial due diligence, so how attractive is the product? Is it what they said they're going to be? Technical due diligence, so does it do what it says it's going to do, and how far is it from commercialization? And then finally, the least interesting but biggest part, the legal due diligence as well. So I'm going to just drum into that a little bit because that's quite long-winded. From a timing perspective, how much time do you put on due diligence? There is quite a lot of research done, probably more than they probably should have done, but hey, some people got some spare time on their hands, that shows fundamentally the more due diligence you carry out, the higher the chances of a successful return. The median, the kind of average amount of due diligence carried out at angel stage is around 20 collective hours per business. Now, 20 hours is a lot of time. It's a good 2 or 3 full-time days for someone. So generally what happens is a DD process is broken up amongst a number of individuals from one group or from one, all interested. So it's important to speak to the founder to see what other investors are also interested, so you can kind of team up and share the process a little bit. It's also, if you think, especially from crowdfunding perspective, that it can be very challenging for a founder to send all this documentation, answer all these questions to so many people when they're only investing a tenner. Or if you're only putting in 5K, you can't justifiably spend weeks and weeks and demands and letters and proof points from a founder. Hopefully the founder's on the ball and has put together a bit of a data room where it's all kind of there and they can help support and answering your questions that you've got. But conducting meaningful due diligence, I kind of recommend, if you can, to buddy up. Groups like Essex, Angels at Essex can help around that by helping to bring investors together around things. And actually, I think they probably, although it's not official, you would have done some DD on them as well, John, when they came in, checked them out, kicked the tires and had a little look and made sure it passed the first muster. But the in-depth stuff, you should be teaming up with others to help do that, which is important. So part 1 of 5 parts in 13 minutes, easy. So looking at the management team, and remember it's all about them, really, yes, your gut instinct, but actually you need to check that they are who they say they are and they have got the experience that they say they are, because there's a lot of chat coming from entrepreneurs and that's quite natural. But looking at LinkedIn, doing some desk research and look at their previous employment. Some investors ask for references, actual references, like they're hiring them from a job, and I recommend doing that. What bits of the team are missing as well, and does the founder recognize that? So really going through their CVs, looking at their social media accounts. Are they party animals that are out every night? Have they got a dodgy background? Have they got a history? You can do free companies' house searches and have a look at the directors and offices and see what they're doing. You might have to pay, I'm not sure, I think it's free. There's quite a few things that you can do to unpick their background and history, just to make sure there's no skeletons there. But also just checking out LinkedIn, getting some references, ringing up previous employers. What were they like to work with? Were they any good? Did they say, he says he was like fundamental in implementing this great thing? Is that true? Or are they just trying to get someone else's glory and they're actually just full of it? So kind of just picking into the, if you're going to hire an employee, it's very similar. I do check social media accounts of potential staff that we hire to make sure there's nothing crazy or weird there. My wife, who works in government, was told, because she had done a tweet, a politically level-minded tweet, which comes up in a Google search when you search her name, she had to go back and delete that tweet because she was going into government, and you can't have any political views if you work in a government agency or make them clear in any way. You have to be super neutral. So there's a few things you can, it's expected. Have a look, check them out, social media, references, try and get to know them. Also, a big due diligence point on the people is the due diligence process itself, getting to know them and how quickly they respond. Are they fast? Are they honest? Are they quick to reply? Are they efficient? Do they really want it? You can really pick up a lot of that stuff through this process in its own right. So these are some of the key things to be looking out for. Financials. Well, what really matters, you get these 5-year forecasts. It's nonsense in 5 years. The biggest thing to look for in financials are a couple of things. So first of all, there will be hockey sticks and absolute nonsense in those financials. I mean, I saw a team just earlier who are a very credible team, very switched on, but they've got a 4 or 5 year bloody hockey stick, and they've got a massive hardware rich business. It's never going to happen. I did tell them that. It's going to be there, right? What really matters though is that 18-month, 24-month cash flow forecast. When are they going to run out of cash? Have they raised enough money? When's their next investment point needed to keep their cash, to keep their runway going, so they can actually stay alive long enough to get to the next funding round milestone? That's what's really, really important. I think also you can do some stress testing on some of their financials around product price and costs, etc. as well, to really unpick it and try to understand and stress test their own financials to pick out, are they being a bit ballsy on, are they being are they going in too much on this? Is this unrealistic? Are they being prudent enough? It's going to be a bit of speculation, right? But I think also, if they have a set of assumptions around customer sales in particular, drill down on those assumptions, and also hope that the CEO, the founders themselves, have been played a major part in putting those financials together, and they don't just outsource it to an accountant to knock it together, because that's when and you'll see, because in the minute you ask a question around price points, they suddenly go, I don't know, which is not a cool sign. The CEO is in charge of the business and needs to understand how and where they're going to make their money and what it looks like. That's really key. So, I'd be really interested in that. It's that 12 to 18 months really is that key bit to really look at. And the hockey sticks, Christ, you could have lived for the next 18 months before you can even look at a hockey stick. So that's the key thing. P&L, cash flow forecast, really important. Balance sheet less so. That's really key in my view. And checking that funding journey, the cash burn, the runway, where they're going to get to, making sure the founder is on the ball is, I think, really important. Commercial. So this is like where they might have been saying, if you had that question earlier about how do you check on their own commercial track record, and this is, the founder might say, we've got some customer sales, we've got a letter of intent. Ask for a copy of it. Ask for the contact number for the customer to have speak to them. Some of the things you can do on a commercial perspective, and this is what they do, is they do secret mystery shopper. When I was younger, the boss used to working in various places as you do, the boss used to mystery shop and ring in the office to see how well we're handling incoming calls. Are we actually switched on? Are we doing the right answers? Are we doing things? Mystery shop them, give them a ring up and pretend to be a customer and see how well get a mate to do it, and see how well they handle it. And actually they can actually do it if they are trading. Speak to and ring and mystery shop the competition, because they might have said ours is 20 times better, but actually you'll see the competition's pretty good. Actually, by looking at it, you said that they were really rubbish, but actually from their own sales documentation that I've just got in front of me, it looks like they're much of a muchness with you. So really start to look at that competition. What are their price points? What are their USPs? And how does that sit within it? So that's something that you can do. Who is the customer and how big is the need around there? And you can speak to these potential customers, do references. Again, if you're just dropping in £5,000, it's not, and if all in a £500,000 round, you're all doing £5,000. If you all individually do that, it may not make too much sense and might be quite frustrating. So maybe try and pull this resource and this activity together to really get understanding around what are the commercial potential. And it's not hard, because there's not going to be much commercials or that many customers, because it's an early stage business. So but it's well worth putting the time in here and just trying to get a good feeling that they are out there and you can speak to them. If there's someone on the advisory board or on the board or an investor who has a lot of industry experience, it's no harm to say, hey, Mr. Founder, Mrs. Founder, can you please introduce me to this investor, this board advisor? I want to speak to them to have a chat about how you're just have a chat with them about the business, and you have a frank conversation with another investor to give you confidence that this is pretty good. So all these assumptions, all these things that you kind of get in your mind as that comes across during the founders' presentations, various to you, go and get the proof points for it to make sure it's actually there. I think is really important. So technical can be challenging if you're a non-technical investor, and let's be honest, most investors are not super technical when it comes to the actual IP. There might be one or two within the space who have experience with the industry, but it's just less likely, and don't worry about it too much because you can rely on others. I think there's a few really big things that to me that stand out. So one is the technology developed for their product, is it actually a standalone technology, or more common, is it a series of off-the-shelf technologies that they're stitching together? And then to what extent is the way they stitch together protectable or non-replicatable? That's a really good big thing to look out for. Nowadays, there's so much available off the shelf, both digitally and physically, that actually you need to make sure that when they bring it together into one seamless proposition, that actually is valuable in its own right, and someone can't replicate it super easily. So hence that, our parts license or off the shelf, have they actually got ownership of that IP? Just check where the IP sits. Often you'll see the IP sits in some random company over here, and there's a lifetime licensing arrangement into it. And it's just make sure that all stacks up, and that actually the founder isn't having their cake and eating it by having a share of a big business that you're investing in, whilst also secretly owning all the IP themselves. So just check some of those things, and a lawyer can do that as part of the process as well. There's so have a look at that and check they've got patents filed. Check the patents, have a look at them, make sure they're there, they exist. Try to understand if the technology is actually ready to market, because often it's not, and it's got quite a long time to go, and that's fine. But it's the extent to which. What you don't want is a founder building up a big picture of a great, kind of like product, a customer pipeline. Oh, it's really good pipeline. But then you find actually in reality, yes, it's working on your product is working on your desktop now, but to get it into a nicely boxed, commercially saleable process is a massive, massive leap. And so actually selling it to those customers could be 2 years away. So trying to understand that is really important, so that you don't get any nasty surprises, or the founder hasn't in any way misled you intentionally or unintentionally. Also, we are investing at a time of great technological upheaval and shift. With coronavirus, we've seen, I said the C word, I'm not going to say the B word. With coronavirus, things have changed and shifted. EdTech's at the forefront, health tech, digitization of healthcare systems. We've frog leaped 2-3 years of technological advancement being forced to by the corporates having to adopt technology. Things shift and change is what I'm basically saying in an annoying way. Does what they're doing stand the risk of complete obsolescence? And that does happen, because they might have a great product, but actually what you hadn't realized is that they're developing something completely different that just sits over top and means they don't exist anymore. So just bear that in mind. There are plenty of examples of that in history. So just give a bit of thought to that. How likely is this technology to be written off in a short space of time? For instance, and it's not necessarily fair, but just to bring, a year or two ago, there's a massive amount of investment and noise around hydrogen fuel cells, for instance, and it's now shifting away from there. It's now shifting back again. Battery technology. There's a lot of investment going into efficiencies in diesel engines, but they're being phased out. So if you invest in a company that has great technology in diesel engine efficiency, you're probably better off investing in something that's looking at looking in electric vehicles and battery technology, to be quite honest, because it's going to be obsolete in 10 years time, because 10 years is your exit timeline. So you're really going to think about the future. So 3 minutes left. I can run a bit over. I don't know if anyone else can. I've saved it for the best bit for last, which is legal due diligence, which is unbelievably complex and boring, but important nonetheless. And I've got the legal due diligence checklist, but things in there like the share structure, like who owns the shares and where are they? Are there any options out there they haven't mentioned or forgotten? Employment contracts, like for instance, when they were often you hire in, in digital and software, you might hire in lots of contractors. Did they have a contract that made sure that IP was yours and not actually theirs? So little things like that to make sure are in place, decent lemon-arts, There's actually, of course, the deal itself, which is a whole other beast about the checking in around that. But the legal due diligence and making sure they've got the copyrights, trademarks, insurances, a lot of that's covered in the checklist that we've sent, and I can send over if I've got a guide, I think I have, send that over and share that as well. Legal costs of due diligence, often, you want to keep them really low because you're only making small investments. Again, it's about pooling investors together. Sometimes one of the investors might be a lawyer and might just say, I'll pick up that one if you guys can do commercial and everything else. If not, then getting legal costs is normal. Often either the founder, sometimes it depends on what you want to do. If it's not a hugely expensive legal cost, they can be deducted from the investment as it goes forward. Sometimes investors just take it on the chin. Sometimes they say, we will pay for it, the legal costs, and take that one completely. However, if anything meaningful arises that you have not disclosed, and as a result makes us not able or willing to invest, you pay for the legal costs, because that means that you're holding the founder to being very open and honest throughout the process. So some warranties in there can always be helpful. So bear that in mind. And obviously a whole bit of due diligence around the deal and around the terms and the shareholders agreement is a big piece of work itself, and it's probably an hour session in its own right. Any questions? That's pretty much it on the DD slide. I mean, it's a lot to cover in an hour, so hence we've not gone into too much depth so that you don't all keel over and die on a Tuesday afternoon. But has anyone got any questions or queries?
No, that's fine, Rod. We're doing okay. And just let people know that we have got a whole hour-long section on the legal documents that you need, just to cheer everybody up. Our friends at Seed Legals will be taking us through that later on.
To Anthony Rose.
Yep. So we're, please just watch out for our forthcoming webinars, because we have some interesting topics covering financial, EIS, SEIS, the legal aspects and various other aspects of working with your founders. Even if you want to know about social media, what your founders should be doing about their social media, we cover
all the dodgy photos, as I've already kind of alluded to. Questions come in, will we share the slides? I've already yeah, we can share the slides.
Yeah.
I've already shared that.
We will be sharing the slides with everybody and providing the YouTube links and any other supporting documentation. We are here to help our investors as much as we help our founders. And in fact, we probably help our investors more so. So please, if you need anything, if you want anything, just ask. And whilst we're on the asking...
Sorry to interrupt. The questions come in. It takes a while to tap it into the chat. Would you trust any DD materials pre-prepared by the founders, or does it need to be independently sourced? You have to trust it from the founders. This is the other thing. You can't independently source their own stuff from them. This is the thing. You have to, Mike, unfortunately. But it's actually not that common that there's a lot of fraud. Founders are trying to make things happen. There's often mistakes and things are overlooked, but rarely actual kind of really lying and sending fraudulent stuff. So I think all in all, if there's ever the whiff of you couldn't trust it from them, you shouldn't invest or go near them with a barge pole. So yeah, trust it. I think you have no choice, really. Sorry, John.
No, thank you, Rod. Thank you for spotting that. I missed that one coming through. So it's our turn to ask now. I would like to ask our attendees a question. Josh, would you like to hold the chair?
Yes, thank you, John. So again, like before, a multiple choice question. Do you feel more confident with investing following this webinar? Yes, no, or I would like to know more. And if you would like to know more, please do feel free to email us and with exact topics that you'd like to hear more on, and we can add that into our schedule of webinars. Okay, we'll end it there, and I'll share the results with everyone. And there you go. Thanks for that, Rod. As you can see, most people there saying they do feel more confident.
Because they knew I'd see the answers, so they didn't upset me there. So I know some of you are feeling less confident as a result of it. I know it. That's good. And yeah, brilliant. I think probably more than 30% for no more, because it is a light touch, kind of trying to tip of the iceberg kind of session, but hopefully tells you that there's a lot more to look into things.
And as I say, we're here to help. We're here to help founders and investors to get the investment deals that they are looking for, both sides of the fence. And we are, if you like, the honest broker here. We're here to make sure that people don't make mistakes, or at least the mistakes are acceptable levels of forced errors, as they say. Thank you very much, Rod. It's been
Pleasure.
thoroughly entertaining. We're only over by a couple of minutes, which must be a record for you. So thank you so much indeed. And the questions that have been coming through from our attendees, thank you very much indeed for your engagement as well.
Yeah,
watch out for our further series of webinars. We will be sending them out to you, so there's no excuses. You must attend. No, you are free to attend any that you wish to. Thank you once again. Thank you very much indeed. Thank you, Rod. Thank you, Josh. Thank you, everybody. Goodbye.